Hey everyone, Alyssa and Nicole here with Blondes Breakdown Real Estate. We're almost done with our series on buyer contingencies. Today we're super excited. We have loan officer Kathy Fitzpatrick with us. She's going to discuss the loan contingency. We're going to dive into everything the loan officer needs to do during the transaction. We're really grateful to have Kathy on today. And we look forward to her educating everyone on the loan and the loan contingency. So without further ado, welcome Kathy.
Oh, thanks so much for having me. I really, really appreciate it. Very, very grateful and honored.
Awesome, Kathy. Okay, so before we dive into some questions, if you would please give us a little introduction and background on who you are and what you do.
Sure, I would love to. So I have the opportunity to be a loan officer. I've been in the industry, I always say 30 years, and then that was like 5 years ago. So well over 30 years. And it's interesting how sometimes in life we fall into something, and I don't know how often it happens. I never grew up saying I wanted to be in mortgages, but I literally fell into something that I absolutely love. Started inside out, which I think was really fortunate. I started as an underwriter, a processor, and all of that, which has been really beneficial, allowing me to really learn how to structure loans and put together things that work, and to be able to give guidance to clients who maybe aren't quite ready to buy, but we want them to get there, and to be able to give really practical steps. And honestly, nothing gives me greater joy than walking someone through. They come to me day one, kind of discouraged, thinking they're never going to buy, and maybe a month, 2 months, 6 months, even at sometimes 2 years later, to come back and be able to allow them to buy a house is incredibly gratifying. And what I always tell people like you and everyone is, what other business is there where we literally change the trajectory of people's lives within 30 days? They start out, they don't have a home, and within 30 days they have a home, which is a vehicle for future investment, for stability, for a place to raise children, for memories. And it's just such a joyful experience when done properly that I'm very, very grateful.
Couldn't agree more. We just had a great one that was exactly what you were talking about. So.
Yeah. And thanks, Alyssa. That was, we were just talking about it. That was the picture perfect scenario where the client knew what they wanted. They're starting their chapter. They want to have their kids there. All of it, it just makes it so much fun.
So much fun.
Awesome. Well, give us a little summary about the loan contingency and the timelines that are set out in the RPA and how that pertains to the loan officer you choose.
So what I have found is that one of the challenges in the current marketplace is that there are multiple offers on every property for pretty much every client I'm working with. So I tried to find a way to be able to improve their chances when they make an offer. How can I have them stand out from the crowd if there are multiple offers on a property? And so I tried to think about from the perspective of, if I were selling a home, what I would want is to try to remove as many variables as possible on the front end, so that when they go to make the offer, you, which are amazing at writing the cleanest offers ever, and in addition, if the financing part of that offer can be really clean, it just exponentially improves their chances of purchasing the house. So one of two things. The first thing is to shorten that contingency period as quickly as possible. So again, putting myself in the position of a seller or a listing agent, I think about that period of time from when you accept an offer to when removed contingencies are removed is where everybody's holding their breath. Is it going to happen? Is it not going to happen? So anything we can do to eliminate stress, and the best way to eliminate that stress is to, whenever possible, shorten those contingency periods. And contingency is basically the point in time where you as the buyer say, I'm 110% sure, I'm moving forward, I've inspected the house has appraised at value, I'm qualified, my loan is in place, I'm going to sign something that removes my opportunity to change my mind without putting my deposit at risk. So whenever there's money at risk, obviously, there's a higher level of investment, and the likelihood of that falling apart after that period of time is much less. So again, if we can shorten those periods, it just puts everyone in a comfort zone much more quickly. So the first thing that I did was I have my clients, as opposed to a pre-approval, which is basically taking their information, putting it through an automated system, having it spit out the other end. One of the questions I know you'd asked was, how is it that sometimes someone could be pre-approved, go in, make an offer on a house, have their offer accepted, and then ultimately can't close the loan? And the answer to that question is that I hate to use the terminology, but I'm just going to say it, garbage in, garbage out, right? So it's an automated system. If I say the client makes $20,000 and I plug that into the system and out pops this letter, and then subsequently I look at some pay stubs or tax returns or something to verify that information and find out that it doesn't match, all of a sudden that pre-approval is essentially worthless. And so to remove that question or that doubt, I have the loan submitted to the underwriter on the front end. So before the client identifies a property, before they go into escrow, we submit it to the underwriter approves the loan. So we again remove that doubt of, is this client truly qualified, thereby allowing you to offer without the financing contingency, because we've already got the financing in place, the loan is approved. So the only variables remaining are the appraisal contingency and their inspection. So when they offer to buy the house, they don't know if the value is what they've agreed to pay, and they don't necessarily know if there are going to be issues later down the line that will present challenges for them. So, and we shorten the period. So if it's a conventional loan, I can literally have an appraisal done within 3 business days, which means you can shorten that contingency, leaving only the inspection contingency as the quote unquote variable.
Kathy, I'd like to interrupt you for just a second. And for everybody watching this, you need to realize that what Kathy's talking about is not the standard. Most loan officers will not fully underwrite you prior to finding a property. What Kathy is offering is an unbelievable service that gives you so much power as a buyer, and from an agent standpoint is so beneficial, like she said, in this competitive market to get your offer accepted. So finding someone like Kathy and working with someone like Kathy is a major benefit to you and to your future success.
And just to add to that point, Kathy and I just did a deal together, and the client was up against 4 other offers, and it was his dream home. They wanted this house. And so we submitted a strong offer with Kathy giving us that reassurance that we could remove the loan contingency. That made the difference, and it got them the house. And they had disclosed to me that they were willing to pay higher, and we actually got a straight accepted offer. They didn't even ask for more money. And so not only did it make them more competitive, it also essentially saved them money. So, because we didn't have to go as high on the offer.
And the other benefit is obviously at that point we can move really quickly, right? So what may be a standard escrow period of 30 days, if a seller is anxious to move, and we can come in and say, we don't need that much time, we can close much more quickly. And on a transaction where the loan is approved, depending on loan type, but most of the time we can close in as little as 10 days. So again, you know, if you're competing with someone who's paying cash, that's not necessarily, cash doesn't necessarily mean that that's a great offer. A lot of times the cash offer is going to be lower because the person who's coming in with cash expects that there's going to be some benefit associated with that. We can typically compete with a cash offer, maybe have the client be willing to offer a little bit more, and 10 days, really cash offers can't move much more quickly because there's still a sequence of events to a transaction.
Exactly.
So just to kind of fill our, did you have something, Nicole?
Go for it.
Okay, just to kind of take a step back and make sure that all of the people watching this understand. So explain what a typical pre-approval process would look like, and then explain what your process looks like in terms of what info you need.
Sure. So there are actually two separate ways that first steps into becoming prepared to buy a house. Typically, it starts with a conversation over the phone. You know, I want to understand your goals. What do you want to accomplish? You know, what does your employment situation look like? I usually like to ask, what is your optimal payment? So sometimes I can tell a client what they're approved for, but the thing that's always interesting to me is the person who's, let's say, a single person on their own, numbers wise, will qualify for the same payment that a family of 4 with 1 income will qualify for, right? So obviously very different. So I like to have that consultation up front. It's not just about what I can tell you can qualify for. What does your budget look like? What are you comfortable paying? What things are you willing to give up in exchange for the dream house? So if that means, in these days, I think we're willing to give up a lot more. Okay, we don't need to go to the movies anymore, right? We don't need to buy popcorn in the movies, but realistically, so the first conversation is just a bit of an overview. Here's what I think my credit looks like. Here are what my debts are. That allows us to issue what's called a pre-qualification. basically, again, it was predicated on the conversation. As long as the information provided to the loan officer was accurate, pretty confident. I'm not really confident with that. I always want to go a step further, which is a pre-approval. That's where the client actually fills out a loan application. We run credit. I take documents and review those and match them with the information provided.
Documents.
Pardon?
What are those documents?
So basically what I'm going to be looking for are pay stubs and W-2s. If a client is self-employed, I'm going to want to look at their tax returns over the last couple of years. I'm going to want to understand where their down payment's coming from. If it's coming from a retirement account, I want to look at the retirement statement. I want them to make sure that they can access those funds, how much they can access, over what period of time it would take to access those funds. Because obviously if we're going to do a short contingency, we want to make sure it's not going to take a month to get the money from their retirement account. Checking accounts, savings accounts, all of those things. We're going to run the credit. We take all of that information and we run it through an automated system. So basically the information goes into the system, out comes a pre-approval, pre-approved letter ready to go. That's where I kind of will diversify myself from others, in that then I'm going to take it one step further and send it to the underwriter. So I don't know if you've ever bought a car where sometimes you get pre-approved on the front end and you go into the dealership and you basically have a blank check and they say, fill out the check, you're ready to go. It's essentially the same thing for the mortgage, right? So we're saying, okay, here's a blank check. We're committed. We're ready to lend you the money. Just find a house that meets the criteria as far as the value being supported, and we're ready to close. So again, that added level of confidence, not only for the seller, but also for the buyer. The last thing you want to do is fall in love with the house and then find out there was an error and you can't buy that house. That's really painful.
So typically the loan contingency is essentially for that underwriting process. How do you do that up front? Because I have worked with other lenders who can't get you underwritten up front. How do you have the direct access to that underwriter?
So our company is basically, we're a direct lender, and it's just a program we specifically came up with to mitigate the risk associated with making an offer. So we just underwrite the loan, and it's called TBD. So that means the property is to be determined, but the client is not. We know everything about the client. The only thing we don't know about is the property.
So you guys have in-house underwriters, I'm assuming?
We are direct lender, which means we have in-house underwriting, in-house closing, drawing of loan documents, and all of that all happens internally, which is how we're able to move so quickly.
Awesome. So if you didn't do it in-house, just because we want to explain to people, what is this loan contingency? So
Sure.
typically, what are they collecting during that loan contingency period, and what are the risks for people which could cause them to become disqualified and have to cancel based on the loan contingency?
So the loan contingency is that period of time where all of the information utilized to get that automated approval has to be verified. So any information that went in, let's say that in the decision it said the client made $5,000 a month, then then the underwriter is going to match that information to the documents to support it. If we said the client had $100,000 for a down payment, the bank statement should show $100,000. If the client, let's say the client was going to get a gift, because that's we have the ability to get a gift. During that contingency period, we want to make sure that those funds are legitimately available. I've had circumstances, unfortunately, where everybody's sitting around the dining room table. Yeah, we want you to have a house, whatever you need. Okay, 50,000. Whoa, that's not what I had in mind, right? So during that contingency period, we just have to make sure that whatever information was utilized to make the determination that they were qualified is supported by concrete documentation.
Absolutely. So we know that there are a few big no-nos when it comes to what you can and can't do during escrow when this contingency period is in effect and the underwriting process is going on. So what are those no-nos that a buyer should be aware of?
Appreciate that. So the first thing I tell all my clients is no new cars in the driveway until you own the driveway. You don't need appliances for your new house until you own the house. So basically what you don't want to do is take out any additional debt to increase the balances, because what happens is at the time we issue the underwriting approval, it was based on whatever debt reflected on the credit report. Just before we draw loan documents for closing, we update that information. And if something pops up and a new loan has been taken out or a credit balance has increased, we have to take into consideration that additional debt, which could put everything at risk. The other thing is, it is not a good time to talk about job changes. So if you are in escrow and you get this amazing job offer, if there's any way you can forestall that for your escrow period, that would be highly beneficial. The other thing that I've had happen is sometimes people absolutely, I mean, if you have a job offer and you absolutely have to take it, have that conversation with your loan officer. Make sure that that's not going to impact your ability to close escrow on the house. So those are some of the things that are definitely things to be aware of.
I also have had clients who don't want to talk with their loan officer about those things because they think that then they're like alerting them. And just kind of touch on that, like you're on their team, you're not going to go tattletale on them. Can you kind of explain that?
Yeah, absolutely. So your loan officer, I always talk about it somewhat as like a attorney-client privilege, right? So I'm going to talk through the scenario or the challenge you have, and we will come to a resolution. The worst thing that can happen is to be blindsided by something, because it doesn't give us the opportunity to react and come up with a plan. Planning on the front end, we could pretty much come up with a way to get around most things if we're aware that the challenge is arising. So if you do find out all of a sudden, gosh, I thought I was going to have a $10,000 gift, it's only $5,000. Let your loan officer know. They can rerun the numbers. There's a high probability they can restructure the loan according to that. But if you get to closing and at closing, you think all of a sudden it's not going to matter, it's going to matter. The same holds true for moving money around. You know, if you forgot you had this huge account and all of a sudden you have an influx of cash into an account, the loan officer needs to know, because they're going to need to show where that money came from. If you're going to write your earnest money deposit from an account that you didn't tell your loan officer about, all of a sudden escrow is going to provide them with an earnest money deposit from an account that doesn't match any asset you gave them. That's going to be a challenge. So just logically thinking about it from the perspective that whatever information we had on the front end should match throughout the transaction. And anytime it diverts from that, just have the conversation.
Yeah.
Did you have any other points on that, Nicole?
No, that was good.
I have one other question. What about paying like big things off in the middle of escrow? So
there's really wouldn't typically be any benefit to paying big things off. Now there is on occasion where paying off a large debt will allow them to qualify for more of a loan. The best practice on that is to go ahead and have that paid at the closing. So when you come to closing with your money for your down payment and your closing costs, we also would collect, let's say it was a $10,000 car loan you're paying off. We'll collect that $10,000 because then we know where the money's coming from to pay it off. Escrow is going to send a check to the creditor to make it be paid off, and there's no question that it was done. If we try to play with money moving from place to place, it's like, well, where did that money come from? And then where did it go? And did it really get paid?
And you on everything.
Just try to keep everything in the same lane. So paying off of something, if it has to be done, if there's not a reason to pay it off or qualifying for the loan, just wait, so that at the end, when everything is said and done. And the other thing I tell clients is, whatever money you have, rest assured when you buy a house, you're going to find things you want to spend it on. So don't pay off debt now, because you may find that when everything's said and done, you would have preferred to have kept some of that money aside to be able to do things, to pay for your move, to do things associated with buying a home.
So let me ask you, Kathy, in your experience, have you had people that have, in the middle of escrow now become unqualified for the loan? And give us any stories that you have.
So I did have a client who forgot to tell me that they bought a truck. And again, did the credit refresh, and there was a $550 car payment. And you think I remember it? $550 car payment. And unfortunately,
$100,000 on a mortgage.
Unfortunately, they no longer qualified and had to cancel. And that's just so unfortunate for everyone, right? For the buyer, how do you tell your kids the house we were moving into, and you picked out your room? I hope you want to live in our truck, because you have a truck and not the house, right? So again, and then from a seller perspective, you're ready, you've predicated everything, all your future plans. Everyone has. So what I'll tell you is that if you think that we're not going to find something out, we will. So just be honest on the front end. I've had clients forget to tell me that they owned another property because they didn't have a loan on it. But we run reports and all of a sudden up pops this property. And yes, there was no loan on it, but you still had taxes on it. You had HOA dues, you had other expenses on it that all of a sudden go into the equation.
So let's talk about appraisals and how those kind of work hand in hand with what you are given on a loan.
Okay, so an appraisal, so when you make an offer on a house, it's good faith, right? You make the assumption that whatever you've offered is going to be supported by the appraised value. From a lending perspective, the lender will not take into consideration we will utilize the lower of either the purchase price or the appraised value in determining your loan amount. So basically, if you enter contract on a house and we find that the appraisal came in lower than what you agreed to pay, at that point, it becomes a point of negotiation. At times, the seller will agree, you know, we knew it was a stretch, you're right, and we'll go ahead and we'll adjust our purchase price to match the appraised value. Sometimes they'll say, okay, let's split the difference. Let's say it's a $10,000 difference. Okay, I, as the buyer, will basically come in with $5,000 more in cash. I can't finance it into the loan. I have to be able to come in with cash for the $5,000. And the seller will drop the purchase price $5,000. And at times there's no negotiating. And it's if you want the house and you have the wherewithal and you choose to pay $10,000 more, you just need to be prepared to come in with that above and beyond your down payment and closing costs.
Awesome. The other question I have, and then Alyssa, I'll let you go.
Yeah, you're good.
In regards to termite clearance, we know that certain loans have certain requirements in order to be funded. Can you touch on termite clearance and which loans require that?
Sure. So specifically, it's a VA loan. On a VA loan, we have to have a termite report and a termite clearance. There's absolutely no way around it. The other FHA and conventional, unless it's specifically required in the contract, if the contract doesn't indicate that it requires termite report and clearance, then we don't need to have it. On a VA loan, sometimes that can be a point of concern to the seller, especially if things are very, again, very competitive. The veteran can choose to pay for the work to get the termite clearance. So if there's a termite report and it's $1,000 for termite clearance and the veteran agrees to pay that, they can do that. The challenge is we need to have that prior to closing. So, you know, it's a little hard to do work on a house that you haven't closed on, but it is something that's an option.
But a VA buyer cannot pay for the report, correct?
They cannot pay for the report. That is correct.
But the seller does not have to pay for it either. So like an agent could pay for it or something like that. If that's
or some termite companies, I think, even do some without charging. So yeah, that's always an option.
Cool. Did you have anything else?
I was just going to say, any other requirements that we should know about that have to be satisfied during escrow for, say, an FHA loan or even a conventional loan that we haven't touched on so far?
So the only thing that I would tell you is that what the appraiser is going to look at when they go to appraise a house is going to be far less in depth than a home inspection. So the home inspection, they're literally going to look at that house from top to bottom. The appraiser is going to go in pretty quickly. They're going to do a quick overview. But anything that's glaring as far as considered to be a health and safety issue, the appraiser will often appraise the property. It may come at value, but will be subject to specific things being done before we can close. Probably the biggest requirement that I see on appraisals is that sometimes we send the appraiser and there is not a carbon monoxide monitor, or there are not smoke detectors. That is a requirement. That is a health and safety. So the appraiser will say, okay, the value is supported, but I need to go back out and make sure that these things have been installed. Kind of the other main things is any electrical wiring that's just hanging, health and safety. Heat, we have to have a heater that's working. Have to have water, things along those lines, things you would think that we'd take for granted. And the other thing—
I'm just curious, this is just random. What if somebody comes and plugs in like a portable heater? Does that suffice, or does it need to be like hard
It needs to be hard. Yeah, it can't be portable heater.
Okay, all right, just
You
curious.
have to have actual heat source. You can have, there are some where they're in the wall, they're permanent. Those are fine, but there has to be a source of heat. And the bathrooms have to be working. So I've had, unfortunately, circumstances where the appraiser went out and they were just in the process of replacing the toilet and they didn't get the toilet in. Now the appraiser has to go back out and make sure that toilet got installed.
Mm-hmm.
Very cool. So is there any situation where you would say, hey, I cannot underwrite this buyer ahead of time, they need to have a loan contingency? Or would you say mostly for all buyers, you are capable of getting it underwritten ahead of time?
I can always get it underwritten. The caveat is we have to have the conversation with the buyer. If you're expecting that you're going to have a job change, if you think your job is at risk, we'll have that conversation on the front end. So the only time I get a little bit concerned is if I look at someone and I get some indication from them that they're concerned about their job. But what I would say is that would not be a client, right? We have to use some common sense. And I do have that conversation with the client. That would be the only time I would be reluctant. I would have the loan approved, but if you write without financing contingencies and the client clearly knows there's going to be a significant change happening, then that would be an area of concern.
Okay.
Gotcha. Go ahead.
No, nothing. You go.
I was going to say, so after it's been, fully underwritten and we go through this contingency period, usually the loan officer lets us know that we are CTC, aka clear to close. Can you just touch on what that means and what the buyer should expect, after that point?
Yes, that's music to your ears. So clear to close, basically, when we go through underwriting, even when we do a TBD, there are often conditions associated with that approval, right? So it may be that we have to show money moving from one account to another. Typically, when you write your check for your earnest money deposit, we have to show that it cleared your account. We have to show where that money came from credit. So clear to close means that the underwriter has reviewed all of those conditions, the appraisal, and basically said, everything's a go. We're ready for you to close. And that's the final step before we're in a position to be able to order loan documents. Loan documents get emailed to escrow, and loan documents is all of your final paperwork. So any changes that have happened along the line will be updated on your loan application. Your note, these are the final terms of your loan. This is what you've agreed. This is your loan amount. This is your interest rate. This is your payment. All of that is part and parcel of those final loan documents. And then the best part is that deed, that's basically the seller changing title and putting that house into your name. The client will usually go in at least a day or two before the closing to sign those loan documents. The lender funds the loan portion of it. The buyer wires or brings a cashier's check in for whatever funds are remaining, which is the difference between their initial earnest money deposit and the total needed to close. Once all the money is in place, then the escrow officer will send it out for recording. And as soon as that house pops up as being in your name, that's the magic when you get your keys.
Awesome. I just thought of one other question that I had for you in regards to rate locks. So some clients think that whatever the rate that the lender, or loan officer rather, says, hey, you qualify for this rate, they just assume that that's the rate they're getting, that's the rate they're going to walk out the door with. Can you talk a little bit about how those things can change and what a rate lock is and when it expires, those kinds of things?
Sure, absolutely. So when we issue a TBD approval before you have a property, we know what the interest rate is that day. Interest rates are very similar to the stock market. So if you buy a stock today, you don't know exactly what it's going to be tomorrow, right? Especially in these days, we can use that analogy. The same is true of an interest rate. So we don't lock your loan until you have an accepted offer because that lock is tied to that property. So at such time as you go into escrow, you should be having a conversation with your loan officer and asking them, where are we rate wise? And once that rate is locked, you absolutely know that payment and that rate will not change. So within the component of that payment too, the other thing to be aware of is that there are some things that we don't know when we do a TBD approval. We don't know if you're going to have HOA dues. We don't know if you're going to have mellow roofs, which is an additional property tax. we do our best to anticipate what your insurance will be. Those are all factors that can impact your monthly payment. All of those things are locked in as we move forward, but that interest rate, you have a specific form with a box that says rate is locked. If that box isn't checked, it means you're floating. So if interest rates move up, conceivably that can impact your payment.
So one thing that I know that Nicole and I both do whenever we're working with a buyer is we think of it as like a tripod, like it's us, the buyer, and the lender who all hold this whole thing up. And so if you're out searching for homes and you find one you love, we're gonna do all of our comps and all of our research, and then we're gonna copy that lender to send you an estimate with where the current rates are. That way, you know, if you submit an offer, you can reasonably lock, you know, at this rate. Because if you got a pre-approval 3 weeks ago, rates might not be in the same place.
Correct. And the same holds true. So when we do a TBD approval, we normally will base it on the highest end of what the client thinks they're comfortable paying. So back to that conversation we had, what is the payment that you're most comfortable with? So we're going to want to adjust those numbers when they're ready to make an offer based on the specifics of that property. And if the price is lower, then our payment's going to be lower. If they have HOA dues, then we need to factor that in.
Yeah, and tax rates can fluctuate. So you always want an estimate for the specific property that you're looking to go after.
Absolutely.
Awesome.
Did you have any other points on that, Nicole?
Nope. I'm
No.
good.
I have a very random question. And the only reason why I ask is because I've had a few clients with this. They go to get pre-approved and they get pre-approved. And one thing that they fail to tell the potential lender is that all of their down payment is under their mattress in cash. Mm-hmm. Can you talk about that?
So that's another reason to go ahead and get bank statements on the front end, because then we know if that's the case. If the bank statement shows $5, well, where's the money, right? So in order to utilize funds for the purchase of a property, we have to be able to verify it in an account. And so if someone said, I have this money in cash, what I'm typically going to advise them to do is go put that in the bank today and come back 2 months from now when the beginning and ending balance on your statement are the same. Anytime there's going to be an influx of deposit. Now, there are specific circumstances on FHA loans where sometimes we can justify using cash. I think I've been able to fit the box twice in 35 years. So overall, my advice is always to be, if you anticipate buying a house and you have a bunch of cash at home, please go put it in the bank. Or the other option is, if you have a relative who has their money in a bank, allow them to give you a gift in order to simplify that process.
Yeah, I just thought it was worth bringing up because people don't realize that the money has to be tracked. And even if you didn't acquire the money in any illegal manner, if it hasn't been in your bank, you have to essentially seize it.
And if it can't be tracked, we have to, it's like, I had a client once tell me, I go, well, what did I say? I can't acknowledge that money, or I can't. And he said, well, it acknowledges you. It's there. So I'm glad it's there and I can see it. But if I don't know where it came from, and just to give some background on that, banking is very much driven by regulations. And because there has been a history of money laundering, a history of, unfortunately, terrorism, where people put money in and they utilize properties to launder money or to utilize it for other things, we are held to a specific government standard whereby, as frustrating as it is, we literally have to document any deposit that's out of the ordinary. Now, that's not to say if you got a $500 birthday gift, we may not need to show where it came from. You can write us a letter and say, it was my mom gave me a birthday present. And oftentimes I'll just say, we don't need that money to close. I don't need to verify it. If mom gave you a $10,000 birthday present, God love ya, want your mom. I need to see a check or see something that shows me. So a lot of it has to do with the dollar amount of those unusual deposits. Any unusual activity has to be addressed.
Makes sense.
And just from my experience of going through a couple escrows myself, that is the most tedious process. Is I have a few accounts, I transfer money around, and throughout the escrow, your lender is gonna require you to verify all of those funds. So be prepared. Anything else that you guys think fall under this loan contingency that buyers need to be aware of?
Just be an open book.
Right. Well, and then you all have the inspection contingency that enters into the equation as well, I know. And I don't have much to do with that piece of it, but I know you do.
we're wrapping up our series here. We've got this loan contingency, and then we're going to be hitting on the sale of another property. But all of our other videos on all the other contingencies a buyer's going to see are in our series on the YouTube channel. So definitely for everybody watching, if you haven't watched those already, head on over to the playlist of buying a home, and you can learn a lot.
Awesome. Well, thank you so much, Kathy. I can't tell you how much we appreciate having you on. We will put your info at the bottom of the video if anybody is interested in reaching out. She's a great lender. She can make you more competitive by pre-removing your loan contingency up front. If you don't feel comfortable with that, you can at least have peace of mind that you're not going to have any issues with your loan contingency, and it's one less thing to worry about. So please like, follow, and share. We need more subscribers on our channel, so subscribe, and we will be back covering the last 2 contingencies. I'm sorry, it's just we're doing sale next, correct, Nicole? So sale of a buyer's home is our next one, and we have 2 videos coming on that. So thank you so much.
Thanks,
Thank
Kathy.
you. Really appreciate it. Take good care.
You too. Bye.
Bye.